Alrighty.
You still sharing your poll? You stopped sharing your poll, right?
Yeah, close that up.
Okay.
Okay, we are going to have Luke Templin get started with us. Let me introduce Luke real quick. We have a nice bio for him. Luke is the virtual CFO for Hancock Dana, where he helps organizations grow and prosper by retaining key employees, improving operations, and assisting in developing new lines of business, while also optimizing pricing, reduce costs, and obtaining capital. Luke holds a Bachelor's of Science in Accounting and a Master's of Accounting from the University of Kansas, where I recently found out he was an offensive or defensive lineman. I can't remember which one, but it was fascinating to find that out. I think had a chance at playing in the NFL as well, if memory serves me correct. But as a fractional CFO for Hancock Dana, he's often the extension of his clients' teams, finding ways to help them grow. So everyone, please welcome in Luke. And Luke, I'm going to stop sharing, and you can take over, my friend.
Sounds good. Thanks for that introduction. I think you made me blush a little bit there on the NFL thing.
Hey, it's only true if people don't look.
Yeah, right? Only in a dream, I think.
Yeah,
so,
right?
Yeah. Well, I want to thank the Alliance Group for having me, and thank you, Taylor, for the intro. So we'll start jumping in here on the importance of a CFO. And during a crisis, there couldn't be a better time to talk about this topic. So a little overview here, do another little brief intro on myself, then a 10,000-foot view on what accounting really looks like and what the CFO role in that is. And then we'll talk about a $125,000 bomb you have potentially sitting in your business. And then we'll get into the what, the why, and the when of a CFO. And then I'll give you a little cash flow tip that you can start implementing today in your business. And then we'll kind of get into how at Hancock and Dana we operate as a fractional CFO. And then if there's any Q&A, we can get into that as well. So I'll keep my intro a lot shorter. I am a fractional CFO at Hancock and Dana. My main focus is on clients' financial performance. So the owner can spend their time doing what they love. You can see in this photo, I also love the outdoors and my family. And the other reason I share this photo is the ultimate goal in what we do is we really want to give the business owner back their time so they can spend it doing what they love, whether that be sales or building up their people and culture or spending more time in the outdoors or with family. So this is kind of a very high level of what the three main components are. At the base here, you've got your bookkeeper, right? Almost every business has some form of this where they're keying in the information and the sales and the bills on a daily basis or a monthly basis. The next level here is what would equate to like a senior accountant or controller. Their job really is to make sure that data is accurate and make sure that they're protecting the company from the potential $125,000 bomb we'll talk about here shortly. And then they're going to put together the report. And at the top level, you really have the CFO that kind of, I say, lives in the cloud, right? They need to be out of the weeds. They really need to take that data, analyze it to make decisions based on data, not gut. And they really need to focus on the future, whether that be adding new people, expanding locations, putting in equipment. So that at a very high level is kind of the three components. And you need a little bit of all of them. At a minimum, you probably need two people involved in the process, and we'll get into that on the next slide. So that $125,000 bomb I alluded to, this data is coming from the Association of Certified Fraud Examiners. So this is cases that they actually discovered fraud or it actually got reported. You can see over here the median loss is 125,000. The average is actually more like 1.5 million. Again, these are reported and found frauds. In my experience, most small businesses, they're in this 5 to 6 figure range over here. All of these frauds were found within 14 months. The unfortunate thing is over 50% of those frauds they were never uncovered. And you can see the organization estimates that about 5% of revenue each year is lost to fraud. So I hear a lot from people, you know, I trust my bookkeeper. They've worked for me for X amount of years. They never steal from me. My response to that is it only takes one event in that person's life to change that. And I've seen it happen too many times. All these stories that I'm going to get into, either I've experienced firsthand or they've been told to me from a colleague that experienced it firsthand. So this first one here is an employee had been working for a business over 15 years. She ended up meeting someone online that she had never met in person. This person catfished her, so essentially tricked her into sending them all her personal wealth. After her personal wealth was gone, she started funneling money out of the business. Again, the fraud got detected, but by the time it was detected, 5 figures from the company was gone. It was all sent online to who knows who. The funds were never recouped. The next one here, company hired a employee that was essentially the director of operations, and they were paying them quite well. So they figured, hey, this person should also be able to do bookkeeping, right? And we don't really need to watch them. Well, come to find out, the company started having cash flow issues, and they started getting the notices from the IRS from unpaid payroll taxes. And what had happened was the employee was actually cutting themselves additional checks to the tune of about 5 figures. All said and done, this case was probably more 6 figures because a fraud examiner got involved and an attorney got involved. Very little to none of the funds were collected again. And the most shocking one on here is a colleague of mine walked in to do very similar things to what I do, discovered that the wife doing the bookkeeping had stolen over 5 figures from her own husband, the owner. So again, you can't put too much trust in people. If there's an opportunity, there's potential for it. And where the fraud organization is kind of getting that 5% is lost in revenue each year, we see a lot of death by 1,000 cuts. You know, the big ones are company credit cards and expense reports. One example I uncovered an employee who decided to buy their kid a baseball bat on the company credit card. And in this picture down here, if you don't recognize this, is Monte Teo, who played at Notre Dame, had a very notorious catfishing scandal. He now plays in the NFL. So it can happen to anyone. And again, it only takes one event in someone's life to kind of change that trust aspect of it. So now that you have that nightmare, we'll kind of dig into what we're here to talk about. So what is a CFO? Very broadly speaking, a CFO is a coach, right? So they're there to help the owner understand the financial performance and give them advice on how to improve it. A great coach can help you lead to great success. And as Taylor talked about earlier, I was fortunate enough to have a very successful coach right here, Mark Mangino, who got me a free trip to Miami, and my team's in the Kansas Hall of Fame. We're one of the best teams ever to play. So a coach can take you to great levels. And I hear from owners, you know, well, I understand my financials. I don't really need a coach. My response to that is that really your best use of time? And usually it's not. I mean, most owners don't love financials. It's a necessary evil. They'd be way better off outselling or meeting with customers or meeting with their team and building the team. So that's something to think about. Yeah, you can probably do it, but it's probably not the best use of your time. And the big thing, a CFO really needs to understand the big picture, which I call the 4 Ps. So you got people, products or service, process, and of course, profit. They need to make decisions based on the data rather than the gut, but they also have that holistic understanding of the business. And we'll get into that a little later, why that matters. And then again, they're forward looking. They're looking at ways to grow the business, whether that's take on new debt, cut costs, etc. And then the last thing here is they manage the third-party relationships, such as the CPA, an insurance broker, a banker. We're starting to see more and more manage IT because the two worlds are starting to intersect with each other. So let's look a little deeper on this. So I'm assuming some of you have heard before from either your bookkeeper or your CPA that, hey, you made X amount of profit this year, awesome news. And you kind of think to yourself, well, where'd the cash go? This is pretty common. Most owners understand the income statement, which I equate to a speedometer in a car, but very few truly understand the cash flow statement and the balance sheet, which is the fuel gauge in a car. So you can go 100 miles an hour of growing top line revenue, but if you're running out of fuel or cash, you're not going to go very far. And thanks to Joe Frost for being vulnerable earlier. That's not easy to do, and talking about how his business failed because of cash flow. And that's a very real and common problem. US Bank did a study that shows 82% of businesses fail because of poor cash flow management. And so the CFO really understands how these two intersect with each other and knows what levers they can pull to fix the issues before they become too large. And one example most recently is with COVID, we have a business owner whose operating cash flow was going negative to the tune of $30,000. And so I reached out saying, hey, we need to make some cuts here. So he came back with about $28,000 worth of cuts that he thought he could make immediately. And meeting with him and looking through it, about 20,000 of those cuts did not affect operating cash flow. It was purely a balance sheet improvement. And so I coached him through, here's why that doesn't work and what we need to do to get to positive cash flow. So we're on track now to turning into positive cash flow. So most businesses, people are your biggest cost. So knowing when to hire is key, and this is another area where the CFO can really shine, because you don't always want to put the cart in front of the horse, but sometimes you do, and that's where understanding the big picture comes into play. One example I have here is a client wanted to hire their contractor that was the equivalent of a C-suite person, so very high paid person. In my line of work, we always do a forecast. So we put it into the forecast and the numbers just didn't make sense. It would have hurt the viability of the business. So I sat down with the owners and explained this to them and said, look, I understand that this person is not easy to find and they're far and few between. So my suggestion was to them to have an open and honest conversation with this individual and say, hey, look, we really want you on board, but right now it just financially does not make sense for us. But we also don't want you to leave, and just have an open dialogue. So they did that, and it worked out for both people. The gal was an independent contractor that had some side work that she wanted to finish up. So she got a win. She was able to continue up the side work, but also work for them as an independent contractor. And the business won because at the time it just didn't make sense financially. And again, it goes back to sometimes you have to put the cart in front of the horse. And you got to take on healthy debt to grow the business. So again, that's where the CFO comes into play and can help. I'm assuming to some of you on the call, this looks familiar. You've got your third party over here speaking a bunch of jargon that you don't fully understand. And again, this is where a CFO can help. We understand what the third party needs and we can speak their language. And this usually leads to better results, whether that be better debt terms or maybe understanding how the insurance works and not getting a high as premium insurance plan and putting something else in place to protect you. And then the CFO should be able to simply translate back to the owner what was done and what the action items are. A good example here is we had a client recently purchase a business. They went to their bank to get funding, and the bank required a $300,000 cash escrow. That hurts. So we used our relationships in the banking world to alleviate that $300 cash flow escrow. And so again, another really good reason to have a CFO, or at least a fractional CFO. So we kind of went into the why, back to, the bottom of the pyramid. A lot of companies on this left side of the arrow spending a ton of time and money on inputting the data, verifying it, and reporting it, when they should be spending a lot more time over here. And when you're in the weeds over here, it's hard to do that. And that's why having someone like myself come in over top of these people and do that makes sense. A couple of examples I can give you on this is 2019 was a pretty good year, believe it or not, before COVID. But there's a company that I know of that had one of their worst years, and it was mainly because they had this data. They didn't have time to analyze it over here, and so they made cuts 3 to 6 months too late. Another example is a company was paying 2 people overtime, where if they would have analyzed it, they would have understood that they could have afforded the same cost to hire 2 additional full-time people for the amount of overtime they were paying out. Again, they had the data, but these people were too far in the weeds to sit back and really understand the data and make actionable advice on it. So now we'll get into the win. This is a really good chart that Infusionsoft has put together, and it kind of starts at the small size. So they're grouping companies by employee size. So you can see 1 employee here in sales. And then at the top here, you've got the number of businesses in the US. And I left out on the bottom, there's one more corporate player, but that's publicly traded companies that I'm assuming no one on the call is with. If so, you definitely should have a full-time CFO. But the solo person here, they really don't need a fractional CFO meeting with them regularly. They could probably benefit from some high-level advice. But once you start crossing this level into the partnership realm and you really want to grow into the steady operation, this is when you need to start thinking about bringing on a fractional CFO that you're at least meeting with quarterly. And so once you get to this level, you at least need to start talking to one or start getting advice from one. And it's not until this managed organization size when you really need to start thinking about hiring a full-time person. This mature company, it really depends on the industry. I personally have worked for a $20 million plus company as a fractional CFO. I was able to do that because they did a lot of large jobs. And so they didn't need as much manpower as a $20 million company that has a bunch of $100 transactions. So that's really kind of the sweet spot, is right in here where a fractional CFO can really help your business. And I know some of you that are solo or partner that on a call may say, well, I don't really want to know the how, but before you jump off, I want to leave you with one tip that definitely will help the solo and partnership kind of manage cash flow, and can work for larger businesses too. And if you take anything away today, I hope it's this. And I want you to stop paying yourself table scrap. So what does this mean? So traditional accounting says sales less expenses. So you pay all your people and you pay, all your subscriptions first. And then what's left over is how much you pay yourself, which at times, especially when you're a smaller company, is not much. So my advice to you is stop thinking that way. And the reason for that is most entrepreneurs run their businesses out of their cash account because, like we talked about before, most entrepreneurs don't fully understand how the P&L, the balance sheet, and the cash flow interplay with each other. And it takes time to run those. So if you're purely looking at your cash statement and you're not looking at those items, it's what is called Parkinson's law, right? It's if you have a lot of food on your plate or a lot of cash in your account, you're gonna spend it on these expenses. You're gonna eat the food. A better way to think about it is to pay yourself first. So think of this like a 401k plan or a vacation fund where you're setting money aside before you spend any of your other expenses on food and whatever else. So the formula I want you to think about is sales less profit. So the money that you have left over after you pay yourself, this includes payroll, profit, and taxes for the owner or owners. And then what you have left over is what you would spend on your people and your subscriptions and things like that. Again, if you're a high growth company, there's sometimes this doesn't make sense and you got to take on healthy debt. But for a small company, this works really well. And the easiest way to do this is to set up a bank account that's hard to access, meaning you don't have a debit card, you don't have a checking account, you can't see the money online. So it's out of sight, out of mind. Every month, you're going to have a percentage that you set aside for profit and taxes. And I would suggest at least consulting with your CPA on what they think that should be. It should probably be north of 10%, if not 25%. So every month you're going to look at the cash you brought in and you're going to sweep that aside and put it into this account that you have no visibility on. So back to Parkinson's law, you're going to see this account with a lot less money. So it's going to change your mindset, right? A lot of companies, we're on Zoom today, use Zoom and Slack. You're going to start thinking, do I really need that subscription when I have Office 365? And I think the speaker after me will talk a little bit about this, but you can do pretty much everything you can within Teams that you're already paying for your Outlook that you could with Zoom and Slack. So it'll really make you think hard about those expenses. And then my other suggestion there is don't take money out of this bank account until two things happen. One, you have your taxes covered for the year. And two, you have at least 3 months of expenses in your cash account. Think of this as like a safety net. Once you meet those two, then start drawing out that money. But this is a lot simpler way for smaller companies to look at cash flow. So now I'll jump into kind of the how we operate as a fractional CFO. So our goal number one is we want to flip the triangle. We want you to spend a whole lot less time down here and money down here and more of the time and energy and money up here. So this all starts with an assessment of your process. And so a lot of businesses we see their process looks like this. It's a jumbled mess. There's a lot of manual processes. There's a bunch of technology that doesn't talk to each other. So at a very high level, at the top of the screen here, I have a paper bill that I received from a vendor, right? It probably goes to someone to get approved. I usually got to nudge somebody as the bookkeeper to get it back so I can then manually input it into my accounting software where I then go file it away in a filing cabinet. And then at some point, I manually cut checks to have hopefully someone else sign to eliminate that bomb. And then that gets mailed out. And then some other time later in the month, I manipulate the data as the bookkeeper to run financials so they're somewhat meaningful. And the owner looks at it and says, well, this expense doesn't make sense. Why did I spend 10 grand on XYZ? So then the bookkeeper goes back to the filing cabinet to pull that out so they can see what they spent. Pretty common process, very inefficient. So the whole intent of this is one, look at the process. How can we make it better? How can we make it more efficient? Then what technology can we layer onto it to automate it as much as possible? And then the third thing is, where is there areas to mitigate the risk of that $125,000 bomb going off? So these are some technologies that we've used in the past. There's others that we have in our toolbox, but essentially at the spoke of the wheel is a cloud-based accounting software that talks to other things. So QuickBooks Online, Xero, Sage Intacct, NetSuite. So that AP process we just talked to is this Bill.com up here. So what Bill.com does is you get an email dedicated to your business where all your vendors send their bills. And I understand that's not going to happen fully. So there's an app and you can also scan in bills to it. What happens when that bill hits this inbox is it starts scanning it. There's technology that will read the invoice number, the vendor name, the amount, the date due, and then you kind of educate it as it goes. So if there's a vendor you pay a lot and it gets coded to the same account, it will learn that. And so once that you still got to have someone involved in it looking over, making sure that the technology is doing what it's supposed to. So once it looks good, you can push it into an approval workflow where someone on their phone can approve the bill before it gets paid, again, to prevent the bomb going off. But the other beauty of this is that bill then gets kicked into your accounting system. So if I go run my P&L in QuickBooks and I want to see what I spend $10,000, I don't have to ask anyone anymore. I drill down into the detail and I can actually see that bill that came over from bill.com. The other beauty of this is when you're ready to pay the vendor, there is no more cutting checks, signing checks, and mailing checks. Bill.com is going to reach out to your vendor and say, hey, if you want paid faster, sign up for ACH. If not, we'll cut you a check. And Bill.com actually cuts the check for you. So it eliminates the manual processes, and then it also adds a layer of protection in there for the business. And so that's the first step. We want to try and streamline this as much as possible so we have near real-time data. So again, we can spend more time up here. The next part of this is we're going to take a deep dive into your financials. Most financials I see were designed by a tax CPA. Love them, but their goal at the end of the day is to complete a tax return. I care what you spend on your meals and entertainment, but I don't care that much. They care a whole lot because they have to report it that way. Your financials really need to tell a story. You need to know the different lines of businesses you have, whether or not they're profitable, and it needs to be easy to see. You don't want to spend a bunch of time manipulating your data to figure that out. And so it's looking at your current financials and your current product or service offerings and re-engineering it so it can tell a story. And then also at the same time looking for potential cost savings as well. And so once those are in place, and in some instances businesses already have those done, we come in as a fractional CFO. And at a minimum, we're going to create a custom dashboard with some key metrics that you, your team, and us can see anytime, anywhere. And so here's an example over here of that. Also, we are going to create a 13-month rolling forecast and budget. So when we hear things like, hey, I want to hire XYZ tomorrow, what does that look like? Or we plan on adding a new location, what does that look like? And so at the heart of what we do, it's at a minimum, a quarterly or a monthly meeting to go over the past financials, go over the future forecast and budget, see what new clients are in the pipeline, what new equipment or people you're trying to add, and then provide actionable advice on that information. And then also from time to time, bring in third parties. For example, if you do taxes here at Hancock Dana, it would have one of our tax people in for a planning meeting at year end, or your other CPA. And with all of this, we do it at a fixed fee. The main reason being, we always want you to call us and not feel like you're on the clock when you're ready to pull the trigger on buying a new piece of equipment or hiring someone new. And again, at the end of the day, the object here is get the owner more time to focus on what they love doing. And that's the ultimate goal. So that's all I have today. I'll open it up, start looking at the chat for Q&A. But if you have any questions at all, feel free to reach out. Here's my email. This is a link actually to my calendar. Happy to jump on a complimentary 15-minute call with anybody. But that's all I have, and I will start perusing the chat to see if we have any questions.
So would he know how to get money to start a business?
Yeah.
I mean, that's part of.
Luke,
That's
Yes.
my question.
we've got a question over here. We just got done with our roundtable discussion and chatting with 3 entrepreneurs and 3 business owners. And one of the questions that came up was just, how do you get money to start your business?
Yeah, great question. It all depends on the industry, right? Banks. So, and you laugh, but I'll give you a real answer. So banks don't like what we call blue sky, right? So if you're a professional service industry and you don't have a owner operated building or equipment or inventory, some banks, they just won't lend to you. And usually the route you have to go is the SBA. The SBA has small business loans called a 7A program. Unfortunately, we just missed the cutoff, but about a month ago, you could have got 6 months free to start a business. But that's the traditional route. I mean, there's crowdfunding, there's bootstrapping, there's all kinds of different methods. It just depends on what you're trying to accomplish and what your appetite for debt is.
Is there a specific, like if you want to own property, for example, that can be like, because the banks don't want to loan you money if you don't have like collateral, things like that. Is there a good route to go on that? Like, can you still get loans through the SBA to do like property management, or?
You can, yeah. So if that property, some banks will lend for real estate, especially if it's owner operated. But there are SBA loans as well for real estate.
Okay, awesome.
And then Luke, what's the market for a fractional CFO? I mean, how many small businesses are requesting that? And I know you had that graph, but at what stage are you seeing that happen? I mean, is it when they get to a certain employee count? Is it when they get to a revenue number that they're just that's too big for them to manage?
Yeah, we're seeing more and more of it every day, especially in a pandemic, because there's a lot of healthy companies that historically they didn't have to look at anything but their cash statement, and they were able to operate that, and it's easy to operate that in good times. But when the pandemic hits, it makes this stuff a lot tougher. And the sweet spot really is this steady operation to manage organization. And it's really an organization that's looking to grow, right? So if you could be a steady operation and what I would call a lifestyle business, like you're doing it because you love it, but you really have no ambition to grow it. A fractional CFO on a quarterly and monthly basis probably doesn't make sense. But if you want to take the steady operation to a mature company, then it definitely makes sense. And this is probably one of my favorite graphics, just because it shows, and you can see how many businesses are in this realm as well.
Jane, do you have any questions about this?
No, but I did jot down a couple notes from this graphic. I thought that was interesting.
Yeah, it looks like we got one question in the chat. So how are you forecasting during uncertain times due to COVID? That's a good question, because a lot of times when we put a forecast together, we're bringing in historical data, and then depending on what's going on in the pipeline with new customers or with expenses, we're using that in our forecast. Well, during COVID, you can't do that because we're in unprecedented times, right? And so at a minimum, you need to do a worst case scenario, unfortunately, assuming you have no cash, and you really got to understand what your fixed costs are, like what you absolutely have to cover to maintain business. So at a minimum, I would do that worst case scenario, and then I would do something in between that and a rose glass scenario. But it is very challenging to forecast in these times. And then I got another question. How would you define healthy debt versus bad debt? That's a great question, Jake. So bad debt is really you got to look at back to the property example, right? So you got to look at that property, how much you think it can generate, and then say, okay, here's the purchase price. Here's how much debt I'm going to take on. If that is north of 10 years before you're ever going to pay that debt back, it's probably bad debt, unless you really want to wait that long. So it's kind of looking at how much you think that asset or that person is going to generate in revenue, and then compare it to the debt and look how quickly you can pay that debt off. And then it kind of becomes your comfort level. And then ask if I would do pro bono work. Depends, but probably not.
Luke, I do have a question in the Q&A section that's from Bruce, and he's asking what the estimated cost of a fractional CFO might be.
Yeah, great question. So it depends on the industry and what all we're going to do, but at a minimum, I would say it's about $1,000 a month.
$1,000 for what?
A month.
Okay.
All right. Any other questions?
To jump on a call with you if you want to dig into that a little bit more.
Perfect. Yeah, and I have your contact information, and it's posted right here as well. So if we have any further questions and somebody wants to reach out for your services or just wants to get some of that pro bono work, I'll certainly send them your way, buddy.
I'll give you 15 minutes. That's for sure, Jake.
Awesome. Well, Luke, thank you so much for your time today, man. I really appreciate
Yeah,
it.
thanks for having me. You guys have a good one.
Yeah, you too.
Thanks. Is there something?